Welcome to another episode. In this one, we look at the stock ratios. Before investing in the stock, that is on the shares, you need to look at for the who are the promoters of the company, what are their background, and what are the other companies they have promoted, and more importantly, about the product. I mean, each and every product kind of have a product life cycle. At what stage they are, whether they have reached the saturation stage in the market, or whether the product is has entered the market and it is at the growth phase, or whether it is the product has just entered the market and it is the hype phase. When it is a hype phase, particularly everybody will go and procure these stocks. But after a certain stage, what happens is that the hype drives down, or hype dries off, and then there is a kind of a fall, and before it again starts growing up. Ideally, if you look at it, I mean, I'm talking from a technical perspective. Say, for example, cloud technology. Cloud technology, a few years back, there is a huge hype for cloud, that is cloud technology in IT industry. And then it slowly fell off, and now it is getting stabilized. Of course, everybody has to move towards cloud, no doubt. But if you look at somewhere in 2018, 19, 20, there's huge hype for cloud. Then it got the hype drive down, and then it started stabilizing. And similarly, now everyone talks about AI, that is artificial intelligence. So it's a kind of hype, data science, kind of hype. Yes, there is a need for it, but then it will slowly gets dried out. There's not much opportunities. Yes, there are opportunities, but not that much opportunities that is projected by the market. So slowly, probably it will die down, and then it will naturally there is a requirement, no doubt on that. But then after the post hype, it will start again, start stabilizing as well. So those are the product, who is the promoter. All this needs to be looked. What is the quantum of investment? Those things to be looked at. But what are the additional parameters you need to look out for? What are the stock ratios one need to look out? So there are four or five ratios we look out them. One is the first one is um, earnings per share. So that is net income minus preferred dividend divided by number of shares. Better described with an example. So the weighted average is the average between beginning, because one particular period, because each time the share number of shares on an annum can vary. So it's the weighted average on a particular period. So that's total outstanding shares is the weighted average. And more importantly, the higher EPS means the company is profitable and enough to pay out more money to the shareholders. Lower earnings per share means lesser profitable. So this is kind of an yardstick. So better we take an example and then look at it, particularly with this ratio. Profit to P and E ratio is very important. So you need to look out for the P and E ratio. Let's say a company's earnings is 1,000 rupees, and they have 100 shares. So in that case, earnings per share is 10. Natural, 1,000 by 100 gives you 10. Earnings per share is 10. And the company is trading at 100 per share. So if it is 100 per share, naturally P ratio is share price, which is 100, divided by earnings per share, which is 10. So naturally the PE ratio is 10. So the higher PE ratio, because if you look at it, there are companies which are more than 30 or 25% above. Generally, it is said as there is no benchmark, but it is said as kind of a overvalued. Less than that, I would say it is undervalued. There could be other reasons also. At times, undervalued happens because the company's past performance is not good. In that case, also there could be the PE ratio is less. Nevertheless, look at the PE ratio, that is profit to earning ratio, and if it is more, if it is because particularly if If a company which is from a well-known promoter, maybe like Tata's may have higher PE ratio, it could be overvalued, and particularly when the stock market is doing very good, you'll find most of the shares are overvalued. So you need to be so if something like, if you find a good company which has good track record, then if it is PE ratio is between 10 to 20, yes, it is recommended to buy those share. So PE ratio is one of the important one to look out for the stocks in the range of good company in the range of 10 to 20. Yes, ideally recommend for a purchase or a buy. Next one is PB ratio, that is price to book ratio. That is the value is market price of the share to book value per share. How do you determine the book value? That is important. And then again, that's where we'll take an example. Let's say a company value of the company is 100, depending upon its whatever its revenue, its goodwill, it's about 100. I mean, it's 1,000. And suppose if it wants to value of the company, determining the value of the companies, there are, I'm not going into the details, but then yes, if it is known that it is rupees 100, and if they want to close out the company, out of which 1,000 they already have a debt, so loan repayment is the priority because they have a higher precedence. So out of which 400 is goes out, and also some assets will fetch 200 rupees. So basic mathematics. So 800 becomes the total book value of the company. Which means then the next question is, there are 100 shares. That means the book value is about 8 rupees. 8 book value of the company per share is 8. So let's say the market price is 80. In that case, what is a PB ratio? It's going to be 10. And again, if a company has a low PB ratio, then it is said to be undervalued. High PB ratio, it is overvalued as well. So these are just the yardstick. And again, due diligence has to be made, checking out the past performance of the company, then look out for the PE ratio and then the PB ratio and decide which one is good. But all this, you can make a note of it, because with an example, it's much more easier to understand. So in this case, yes, PB ratio looks, in this example, 10 looks okay. Then probably you could buy those share as well. Dividend yield, because some of the companies doesn't provide dividend as well. Dividend yield is always zero, but most companies do provide. But that is one more yardstick to determine whether it's worth the buy or not. One is that yes, always look for capital appreciation of the shares. The other one is dividend as well. So time to time that has to be provided dividend, because once dividend payout happens, then the retained earnings, which is going to be invested in the business, comes down as well. So dividend earnings is the dividend yield is an important factor as well to look out for. A company is trading at 10 and it issues a dividend of 1, then it is the company's dividend yield is 10. So out of which it is again out of the first one is of course the earnings per share, PE ratio, PB ratio. Then the fourth one is what is dividend yield. The last one, no doubt, is debt to equity ratio. What is the depth of the company? The lower the depth, better it is going to be, because and the company is not doing well, and um, equity shares is again, I'm just giving an example. It is just the equity share is only fetching 10 is the equity share is issued. Even after a couple of years, the equity is doing only at 10. Then the promoters cannot sell the share because that's not going to give you any higher value. In that case, they take the debt route. They take debt to fund their growth, and higher the debt, the challenges it's going to have. So you need to look out for the debt to equity ratio. So the ideal one is no debt is always or lower debt is always better, or less than 1 debt is in the ratio of 1 is good, particularly for a stock exchange company or a stock market company, lower debt is always good. Or if they are bringing the debt to a lower compared to a previous year, that means it is also on the growth trajectory. So these are the five ratios you may have to look. The others could be return on capital employed, but ideally I would look at all these ratios. First is earnings per share, PE ratio, PB ratio. What is the depth of the company? Whether how much is the their revenues? Revenues, are it growing um, year on year basis? What are their net profit? Before I decide to invest on the stocks of the company. So you could use this as your yardstick, and then decide which one to provide, which one to invest as well. I hope you found this presentation useful. Thank you. Cheers.